Hello, everyone. This is Steve Sanangelo from the SRS Rock Report, and I'm glad to be here. I will be doing the presentation, The Energy Cliff, a world moving from building wealth to protecting it. This is what I presented at the Silver Symposium. No, it's not a copy or video of the presentation because Bob hosted the breakfast, and everything costs money, unfortunately, and the price tag to record it by the audio visual guys, it just wasn't worth it. So I'm going to do the presentation now. You've seen some of these slides, some of this energy, but I'm going to talk more about it. Uh, and I hope more of the light bulbs went off because it actually did for me. As I was explaining it, it actually made more sense. So what I showed to the attendees is this is the falling EROI chart on the left. We're going to peak in actual amount of barrels of oil. That's going to happen and it's going to decline. And unfortunately, the energy quality or the net energy that comes from the remaining oil is going to really decline. And that's why we're going to hit the energy cliff. And that's why it's going to be very difficult to build wealth. Some will, but most are actually going to survive. So it's important. This energy cliff trigger, I call it a trigger, is going to force people to protect their wealth. And you can't do it in the massive financial bubble. And that's what I'm going to talk about. Now, you've seen this, but I wanted to share this with the attendees there. Energy drives the global economy. I wanted to nail the point down because all we are doing, we tend to forget about it. We burn energy, all kinds of energy. We produce goods and services, and we trade those goods and services. And I don't think people realize, and I told the folks this, 1 barrel of oil, which now is less than $90, is the energy equivalent of 5 years of human labor, 5 years of one person working. That's how much it is. Now, the financial markets are supposed to steer the economy. And what they're supposed to do with finance is help bring all these things we need, energy, food, and goods to the market. They're no longer doing that. They have massively separated from the physical economy, and I'll show you. So if the most important thing is energy drives the economy, well, then money should be logically a store of energy value. Gold and silver do this. They're stores of energy value. Fiat money does not do that because I told the people an ounce of gold now costs $1,700 to produce on the top gold miners, $1,700. A $100 bill costs 15 cents. That's the anti-counterfeit $100 bill in the United States. You could do it. You can make a lot of them for pennies on the dollar. The reason why fiat money does not store value because it doesn't take much energy to produce it. Folks, it all comes back to the energy. Now, this is where it gets interesting. The energy cliff is going to destroy the inflated financial assets that are now 10 times the physical economy. And again, this kind of clicked in my head as I saw it. Now, I researched it and put it together, and I'll show you. I'm going to talk about that. But many of you have seen this already, but the attendees didn't, because Jean-Marc Jancovici did a presentation to the OECD in September showing the relationship between energy and economic growth. And what I show here, from 1968 to 2018, we've got total world oil consumption, 3-year average, total world GDP per capita, 3-year average. And what do you see? As oil consumption goes up, so does the GDP per capita. And it comes down when it goes down. So there's a direct relationship between GDP 1-to-1 with oil growth. However, that has been changing with the debt, and especially in the United States. Now, I showed this chart to, I think, the gold members, so everybody gets to see it. I did my own research from 1950 to 2022. This is total real US domestic GDP in 2012 chain dollars versus the public debt, that's in red, the GDP is in green, and the energy consumption is in yellow. What I'm trying to show here, I didn't do the 3-year average, which kind of like it averages things out. But I wanted to show there was a direct relationship between growing energy consumption. Now, this is in quadrillion BTUs. I did all energy. And we all know what a quadrillion is. We hear a quadrillion in derivatives, a big number. We're burning 1,000 quadrillion BTUs a year. of energy a year. So this is energy consumption going up. And what do you notice? GDP is going up in parallel. We hit the recession because energy prices skyrocketed, and we saw the energy consumption fall, GDP rolled over, and then we started increasing. But then we plateaued in the early 2000s, but the GDP crossed over. But you know why? Because the GDP is now mirroring the debt. So the debt, I mean, the GDP was now based more on debt growth. And then after 2008, the debt explodes. And there's a reason for that. It all comes back to the oil. I'm going to show you. I showed the attendees. So the GDP now, which is growing here, was based on massive debt growth. And to hammer the point why energy is so important, I had to show a few little history. And many of you seen this, but I like to, go over it again. It was during the Roaring 20s. We hear about the Roaring 20s in the United States. So if you don't understand energy, you think, well, all these smart people in the US, all these inventors created the growth. No, they didn't. They created the ideas. The energy created the growth because we had a 154% increase in average oil production in the 1920s. This is average per decade. And if we look over here, this is global car production. We've got 1924, we got 1928. The United States accounted for 84% of global car production compared to the other leading producers. So with all these cars, with all this oil, with the trucks, we needed roads, we needed new businesses. It was due to the oil, folks. The oil was what made the Roaring 20s. And I've mentioned we had the Depression in the 30s. So people think it was Roosevelt's New Deal or World War II that brought us out of the Depression. No, it wasn't. You can have a Depression, you can have a New Deal, you can have World War II. If you don't have the energy, you can't have the economic ability to do those things to pull you out of the Depression. You needed this massive growth in US oil production. And how big was it? Well, in 1940, the United States accounted for 71% of global oil production growth, of global oil production. 7 out of every 10 barrels of oil came from the United States. We were the Saudi Arabia of the world. Matter of fact, Saudi Arabia never had this much of a percentage of oil production in the world. Now, OPEC produces 38% of total production, and we produced 71%. And if you look at the right chart, the United States, the Allies and the US won the war all due to the oil. Germans didn't have the energy, or the Japanese. Comes down simply to energy numbers. So from 41 to 45, the United States produced 2/3 of all the oil in the world. And they supplied that to the Allies and all the goods. Massive amount of military might from our oil and our coal. And you'll notice right here, at the end of World War II, the United States had 6,768 warships. And for a period of time, we were building one Liberty transport ship a day in the US because we were sending goods and fuel to the Allies and especially England and Germany with their U-boats were blowing them up. So we were building one a day. One a day. After World War II, we had thousands of ships that had to go into mothball because we didn't know what to do with them. So again, it all came back to the energy. Now, if we realize oil is the most important factor for GDP growth, we have to know where it's coming from. And this chart shows it. From 97 to 2008, the rest of the world is in the olive color. The United States is in blue. Canada's in red. The rest of the world had all the growth, 11.4 million barrels a day of growth. The US and Canada actually declined a little bit. So if that's where the GDP came from, was the rest of the world. But in 2008, it flipped. The rest of the world didn't have any growth, really. It was the United States and Canada. Right here, you could see it. And actually, the United States, 85% of the growth in global growth came from the US shale industry. So that's where a lot of the economic growth came from, even though it was inflated. So I showed the attendees this chart. You've seen it. I want to explain it again. This is U.S. conventional and Gulf of Mexico versus tight oil production, 1900 to 2022, actually updated it to 2023 and forecast to 2035. Typically, when you do conventional, it takes time to get into the field. You add more wells, you keep increasing. It peaked in 1970. It declined. We brought on Prudhoe Bay, gave us another peak, and then it's been declining ever since. Now you see these bumps here. This is the Gulf of Mexico. And there's a gentleman named George Kaplan who I follow in the peak oil barrel. He's in the industry. He does a lot of updates, detailed updates on the Gulf of Mexico. We've had some growth there, but he says there's some more projects going to come online the next year or two. But after that, there's no more projects. And so we're going to have a rollover in Gulf of Mexico. And so if you add those together, it's a 10% decline rate. Here is where the party took place in the world, was the shale. Massive growth. The GDP in the world came from this. It declines 45% a year, and you know that. So what goes up comes down in the same fashion. And then I showed them this because they don't have any idea. You all do. They have no idea what's going on with the shale industry. These are the top 4 major shale regions: the Bakken, the DJ Niobrara, the Permian, and the Eagle Ford. And this is the well. This is from 2009 to 2023. This is how many wells were added. This is the production. We could see on the left here, it's 8 million barrels. That's 8 million barrels a day. These top 4 fields produced about 7.5. You add the other small fields, the rest of the country, it's 8.5. So this is where it's at. Now, this each year is added on top, and this is the decline rate. So to understand the natural decline rate, if you don't add any new wells, complete any new wells, we have to see what the decline rate is. And this is 2021. In 1 year, if we don't use 2022, we don't use 2023, it fell 3.2 million barrels a day was lost, 43%. And you add the others, it's about 45%. So this is what we have to replace every year. And we've been doing, but there's a problem. Now, a lot of people, either Americans or people in the industry or around the world, they think, look at the United States. We got all this, we've got billions and billions of oil and shale. Well, this is the Bakken. I'm going to use the Bakken as an example. Now, the gold members have seen this, the silver members haven't. This is the Bakken. This is North Dakota right here. And then this is Montana. So this is the entire Bakken reservoir or field. But folks, all the production's coming from these 4 counties. Because if we look as of June 2023, total production from all of the entire field was 1,179,000 barrels a day. However, Williams, Montreal, McKenzie, and Dunn, 93%. Out here was 7. And you know why? I'm gonna try to make this simple to understand. This oil was really not economic. Under certain circumstances, it is a little bit, especially the stuff that was drilled years ago. Think about this. Let's make believe this is a gold mine and the good reserves are right here. So they really didn't make money, but they kind of broke even. So at 1850 or whatever the price of gold is, that's what it cost the companies to produce gold in this area, 1850 an ounce. So they're barely making money. But it took a lot of debt to get to this gold. Now you go outside this area, it's going to cost you $2,500 to produce that 1,850. So why the hell are you going to do it? Well, let's say gold goes up to 2,500. The problem with the oil industry and the energy return on investment, the price of steel is going to go up. The price to the water, the wages, the salary, the servicing of the rigs, everything goes up. So now that gold is now 2,500, when you go up there to these other areas, it's now going to cost you $3,200 to produce that gold. Do you see the problem? Why then the companies are not going to the outside? Because they're going to lose money. So it's not economic to do it. And it's happening in the Eagle Ford, it's happening in the DJ Niobrara, and it's also happening in the Permian. So what I want to show you, the reason why we're in trouble, this is the top 4 counties in the Bakken, oil production and well locations as of 2006. These are the actual horizontal. So these right here, they're about a mile long. They started about a mile long, then they made them longer. 89 wells were drilled in 2006. It hit 8,000 barrels a day, and it's been declining over the years. Well, this is 2010. And now we're getting to 2 mile laterals, and we could see all the wells now. We got up to 250,000 barrels a day, and we had the big decline. 2015, do you see all the wells coming in here? We got the Bakken is over 1 million barrels a day. All these wells, now they're 2 miles. 2019, look at this. In 2019, that was record, 1.4 million barrels a day. All these wells. And then 2023, all these wells, and we're about 300,000 barrels a day less. So we don't need to be a nuclear physicist. We don't need to be a brain surgeon. All we need to do is open our eyes and look at what's happening here. And what's happening here, folks, we're running out of drilling locations. Yes, they can add more, they can do refracking, but the refracking I've seen is really not economic. It won't really account for much. So what is happening right here in front of your eyes is happening in the Eagle Ford, in the DJ Niobrara, and the Permian. So we're going to start to see a rollover in U.S. shale oil production. Now, it all comes down to this last oil chart. This is what I told the attendees at the Silver Symposium. This is global conventional oil production, condensate, heavy oil. The condensate's in white, heavy oil is in this color. This is the tight oil, United States, which declines 45% a year, and then the natural gas liquids. So people say, there's no peak oil, Steve. Well, if you look at this, you're kind of right. The problem is the stuff that really runs the global economy isn't this stuff here. It's business as usual. It has certain functions, but the conventional is the high quality, the high energy return on investment. And guess what? It's the source that produces most of the diesel. So if you want to get on Amazon, you want to buy a new computer, you push the button, 3 days later, you get your computer. Well, you need that conventional mostly to get you that diesel, to get you that computer. So there's two important things at this on this chart. From 1960 to 1970, we added a massive amount of conventional oil, 24.6 million barrels a day of growth. Folks, this is a one and done. It's never going to happen again. And that's the reason why the price of oil did not change for the entire decade. It remained $1.80. And I told the folks at the symposium, do you know why this is interesting? And I'm going to repeat it to some of you all. Because if you look at what's happening today with the Russian-Ukraine war, you look at Saudi Arabia cutting and OPEC cutting production, and now the Russia just cut diesel exports, and then we had the COVID shutdown. What's happening to the price of energy, oil? It's going all over the place. It went negative, and then it hit 123, and it went down. Now it went back up above 90. It's very volatile because of all these problems, geopolitical event. You go back to the 60s. We had the same geopolitical events. We had the Cuban Missile Crisis. The world almost came to an end. We had the assassination of JFK. I'm repeating myself, some of you folks, but we had the Vietnam War, a massive regional war. We had the assassination of Robert Kennedy, Martin Luther King, the Arab-Israeli War, and countless other geopolitical events. But you know what? Didn't even phase the oil market. Why? Because we brought on a massive amount of oil, mostly from the Middle East. So that's why the price remained at $1.80. Well, if we look over here, the reason why I showed you that chart of the United States and the problem after 2008, the global financial crisis, it wasn't a coincidence because, you see, the conventional peaked in 2006, 70.3 million barrels a day, and it plateaued. And by 2008, we hit 145. And you see what's happened? It's rolling over. We had the pandemic shutdown. It's coming back up. It can come back a little more in 2023, but it's 63.5 as of 2022. It's almost 7 million barrels a day less. This is the good stuff. This stuff is going to continue to decline. It will. This is eventually going to decline, and I'll show you why. And it's probably going to start to decline after 2025. Why? Because of the Red Queen syndrome. And again, the industry doesn't really understand these numbers, and I don't know why, because you go back in 1965, we were bringing on all this production. You have to understand there's three phases to oil fields, like Ghawar in Saudi Arabia. There's the up phase. You're building the growth, and it hit 5 million barrels a day. You've got to add a lot of wells. Then it plateaus. After it plateaus, it goes into the decline period. And you have to continue to add wells because you don't want the decline to be too bad. Well, this is what the Middle East is facing now. It's in a decline mode. So we have brought production up to 95 million barrels a day. This does not include biofuels from the United States or Brazil or refining gains, which pushes it over 100 million barrels a day. My analysis, and I did this on the website, shows we're losing, I think it's closer to 11 to 12 million barrels a day. That's what we're losing every year now. A lot of it comes from the United States. We have to replace a Saudi Arabia every year. And that will become difficult, even though there are more discoveries coming. That's going to become very difficult after 2025 because we're burning 30 billion barrels a year. 30 billion, 30 billion, 30 billion. So this is why we're going to run into the energy cliff. And lastly, about energy, I'm going to get into the finance and the precious metals. Why? Is people say, Steve, well, we're going to have a transition. Unfortunately, we're not, because green energy is a fossil fuel derivative. Now, some people don't like fossil fuels, so it's easier to say that than natural gas, coal, and oil. And if we look at the change in energy consumption by source from 2005 to 2022, where are the biggest gainers? Natural gas, coal, and oil. Wind was fourth, solar was fifth, and actually nuclear was negative. Even though China is adding more nuclear power plants, the world is cutting them down for various reasons. This is going to continue to decline, and China is not going to be able to add all their proposed nuclear power plants. You could take that to the bank. Now, if we put it all together, lump all the fossil fuels together, oil, natural gas, and coal, this was where all the growth came. And then green energy was here, and nuclear was this. To make this green energy, wind, solar, and EVs, you need to take a chunk of this out. And that's what the PhD engineers in wind, solar, and EVs, for some reason, they just can't seem to understand that. You need this to make this, especially nuclear. We're not going to have it. Wait till the growth starts to decline. So we're not going to be able to ramp up green energy. There is always solutions there's always a solution to a problem. There is not one to a predicament. So it comes back to this now that I got people to understand how important energy is, because people don't really understand how important energy is. My subscribers do. Now, why is it going to impact it's going to impact the global economy, but why is it going to impact the financial economy or the financial assets? Well, before I get into that, I wanted to show you that we've been here before. The world, if you go back in history, this is the ancient Roman Empire hit the energy cliff and the currency debasement. You see, back during the ancient Roman Empire, they didn't burn oil, natural gas, or coal. They burned wood. Same thing in the early Bronze Age, same thing in the late Bronze Age, same thing in the Greek Empire. All along in the Middle Ages, they all burned wood to make charcoal to smelt metals. The Romans cut down massive amount of trees to produce their silver, lead, gold, copper, and iron. And right here is a chart. It's estimates of forest clearance in Central Europe. And we could see this right here is 200 AD. They really picked up. What you'll see is that this is the energy cliff for the ancient Roman Empire. There's more to it than that, but it's simply put, it collapsed. So when it collapsed, so did its silver production. Now, if you go over here, this is basically two things: estimated Roman silver production per year and how much silver was in the silver denarius, starting at about almost 100%. It was like 98%, and then a decline. This is from 50 BC to 100 AD. This is when they were producing most of the wood. Then after about 120 AD, it starts to decline. So in this period, they produced the most silver, 200 metric tons of silver a year, average. That's the estimate. But as the wood fuel production collapsed, it fell in half to 100 metric tons. And then after 200 AD, when there was very little wood production, it was 30 metric tons a year. So it was the collapse of their wood fuel that was the reason for the debasement, because you got to remember, around the massive Roman Empire, they had hundreds of amphitheaters and coliseums filled with millions of people, just like today, going to the football stadiums and going out to all the malls and whatever. They had to keep them happy. But the wood production was collapsing. So to keep everybody kind of going and the business as usual, they had to debase the currency. So it wasn't the debasement of the currency that led to the collapse of the Roman Empire. It was the collapse of the fuel, the wood. So I think the attendees got that. I wanted to share that with you because here's where it gets interesting. This is the top four central banks' money supply, M2 money supply growth versus the cumulative value of the gold mine supply growth from 2007 to 2022. Now, there is more money supply, but I started it at 2007 at zero. Because what did I say? In 2008, that's when the global economy went into a convulsion. That's actually when it started to die, right there in 2008, due to the peak of the high quality energy. So what I did is I took all these figures, started them at zero, and went to 2022. So we've got four central banks: the PBOC, People's Bank of China, the Federal Reserve, the ECB, and the Bank of Japan. That's the European Central Bank. And you could see the percentages of the money growth: 60.5 trillion increase in the money supply in just 15 years. And most of that was from PBOC and the Federal Reserve. But this doesn't include other countries like Brazil. You couldn't really get that data. I imagine it's at least another 10, 15 trillion. Look at the gold supply. This is the cumulative gold mine supply, and I multiplied it by 1925. The gold price is now less than that. It's in the 1800s, so it's lower than this. And this is all the gold. This is not just the investment gold. This is jewelry. This is industrial usages, so it's less than this. But let's just use all of it. The money supply from these top four central banks increased 20 times. This is the real money supply, not this. This is going to get into trouble. The currency is going to get into trouble. Now, it gets even worse because now I'm going to kind of put it together with the real economy. This is total global financial asset growth versus global GDP growth and the cumulative value of gold mine supply. The blue is the GDP growth starting from 2007. It increased to 28.1 trillion. Now it's inflated, but that's what it is. It's still the physical economy, trying to measure it. Now, the Financial Stability Board came out a report I'm going to show you in a minute. The global financial assets increased to 273 trillion in the same period. I estimated at 281. Now, I just picked that number due to looking at in the past, but guess what? It's 10 times the growth of the physical economy, which is the GDP. This is the problem, and I'll show you why it's the problem. And again, the gold, it only increased about 3 trillion. So this is the FSB, the Financial Stability Board's report on global monitoring, report on non-bank financial intermediation. In simple, keep it simple, stupid words, it's the shadow banking system. That's what they did this on. And it's as of 2021. I've shown some of you all this. This is the chart. It goes back to 2004, but you could see how much it's increased since 2007. The green is the shadow banking. The red is the commercial banks in the world. The blue, the central banks. And the yellow is the public. Look at the total value is. It's 487 trillion. Total value. And half of it, the percentage, they have a percentage. I'm trying to find out where there's a percentage. It's half of it is in the shadow banking system, right there, 49%. So half of it, we have no idea what it is. And so the thing is, it's increased 281 trillion as of my estimate for 2022. And this is kind of this is what it is. This is the non-bank financial intermediation or shadow banking system assets for 2021. Now, this isn't the commercial banks. This is the shadow banks. 66 trillion in other investment funds. And what that is, the other investment fund assets grew almost 17% in 2021. Fixed income funds, equity funds, all kind of shitty funds, folks. And it tells you how much they grew. 66 trillion. Pension funds, 45 trillion. Insurance, 40 trillion. Captive financial institutions, 24 trillion. Broker dealers, now a lot of these broker dealers are involved in the repo market, 13 trillion. Money market funds. People who took their money out of their bank because they saw, they go, I'm not making any money. They put it in a money market fund because it's earning interest. That's in the shadow banking system. And I'm not saying it's not safe, but it's going to be not safe in the future. And you just see hedge funds, 7 trillion. The people that own the institutions and people that own all of these assets think like they're in a casino. They want a whole bunch of chips. They're going to go in, they're going to cash in. Folks, there isn't the energy to cash them in. And that's where we get to this chart. This chart puts it all together. This is total global financial asset growth, GDP, and total world petroleum consumption growth. What do we see? The yellow is the energy growth, 13.1 million barrels a day. What did I say about what is GDP? It should be 1-to-1. Well, this grew 13.1. The GDP more than doubled. So it's being kind of propped up with debt. But what's worse, the financial assets are 10 times. So what I'm trying to get across to people, we have just enough energy to produce the energy we consume, we put in our gas tank, we use to heat our homes, to run our businesses, to produce the goods and services that we trade. We've got just enough energy to do that. We have no energy really to settle the 281 trillion in asset financial growth in the last 15 years, not including that other, which was 487 trillion, another 200 plus trillion. We don't have the energy. Unfortunately, they're shit out of luck. So when you understand how important energy is, and when we start to peak and decline, GDP is going to fall. What's going to happen to all those financial assets? The world has no clue. And so then I spoke about this. This is the collateral trap. It's a paper by Boise and Cooper, U.S. Treasury debt as a foundation to stabilize the financial system. These are two PhD economists. Basically, they say we make a distinction between outside collateral, and we all know what collateral is. If you want to get a loan, you own a home, you've got 300,000 in equity, you want to do some renovation, you want a pool, your wife wants to redo the kitchen, you go to the bank, you tell them I got 300,000. They say, okay, how much you want to borrow? You want to borrow 100,000 to do all this. They goes, great. They give you a check. That's collateral. So what they're showing here between outside collateral and inside collateral, the use of inside assets such as loans creates the collateral pyramid. This is in the banking system. And that cash flows from one loan can be pledged to secure another. Like you just took out that loan to renovate your home, and now you got to pay that loan back, right? So every month you got to pay me. So that's the cash flows. And then the banking industry just leverages this shit up. And that's why it's called like a pyramid. Well, outside collateral, such as U.S. Treasuries, serves as a foundation of and stabilizes the pyramid. There is a threshold for the volume of treasuries below which investors panic. The pyramid collapses, and there is not enough safe assets to support the wholesale market activity, a situation we call the collateral trap, and that's what we're in. And so what's fascinating about this paper, it's a 36-page paper. They've got a lot of calculus in there. These guys are smarter than they're more smart than they know. But the BIS paper conclusion, larger treasury foundation makes the system more safe. This is the collateral pyramid here. And outside collateral is the basis is the US treasuries. So just to conclude, this is the conclusionary statement. Due to the presence of moral hazard and adverse selection, loans between heterogeneous banks have two major features. First, these loans are collateralized either by treasuries, outside collateral, or by cash flows, inside collateral. Again, that that loan that you made to do your work on your home, that's cash flow. They're waiting for your money to come in. What happens if you get out of work? You can't pay that loan back. But look at the footnote here, 22. Let's go down to the footnote. To be clear, listen to what these two Einsteins are saying. In our model, we abstracted from sovereign debt risk. They just assumed, like the UK gilt market that blew up in the beginning of the year, they're not going to assume any sovereign debt risk. And it almost took down the UK market. Why did that happen? It was the energy. Europe hit the energy cliff in natural gas even before the Russian-Ukraine war. Prices skyrocketed, started to destroy their economy. To bring the inflation down, they raised interest rates. And that's what caused the gilt market to go into a convulsion. They didn't even mention the energy about that. So this is the put the hammer on the nail here. And we also considered treasuries as being safe assets. They didn't prove they were safe assets. They just considered them safe assets. People, I fell off my chair when I read this. And I said the same thing to the attendees. The US treasuries are not safe assets because they're a debt. We had 5 trillion outstanding before the 2008 financial crisis. Now we have 25. So they're saying that US treasury should be the foundation. So if you own a treasury, basically what you can do, well, try this. You've got 500,000 in debt. You go to the bank, you say, listen, I want to borrow 250 more. And they say, what's your collateral? I got 500,000 in debt. They're going to grab all the people in the bank, and they're all going to laugh at you. You don't have any equity. But this is what the market is basing on. And that's what happened. After this paper, US banks bought US treasuries, other countries bought they were buying them because they thought they were safe. They're not safe. And the energy is going to be the trigger that destroys the notion that the US treasuries are safe collateral. They're not. They're debts, they're energy IOUs. And I showed in this chart, because the reason why we have so many treasuries is because the United States just could not, we had a credit card. We had to fund our deficits. We just kept letting Americans live high on the hog. So to fund our deficits, annual deficits, we used treasuries. We took these treasuries, the Federal Reserve helped to monetize them, and that money supply, that's when we built the money supply. And that's why we've got 25 trillion, and that's growing, of treasuries. And that's going to get into serious trouble. So, and then I showed this. This isn't a secret here. We all know about this. This was a global debt leverage is a great reset coming, and it is. This was by SB Global, and they've got a wonderful chart here, and they're showing the mature markets. The United States is included, and this is total non-financials plus financial sector. This is the debt to GDP. 407% when you add all the finance. It's probably more than that because you know what? They don't include the shadow banking, which is even more finance out there. And then if you include the emerging markets, which is less, they haven't gone off the deep end like we have yet. It's 350%. It's all coming to a head. And what is the trigger? It's the energy cliff. So what this all comes back to, all these inflated financial assets will behave like Bear Stearns and Lehman Brothers. Not exactly, but to understand why it's going to happen, because back here in 2006 and 2007, the investors who were listening to Wall Street and Kramer saying how good Bear Stearns were, The collapse happened here due to the trigger of the subprime and then the collapse of the economy. That was the trigger. But guess what? Bear Stearns and Lehman Brothers, they were bankrupt back here. Their assets were worth nothing. The market investors just didn't know it. The same thing I'm trying to get across with the financial assets. There isn't the energy to settle them. The market doesn't know it. So we're going to face a global Bear Stearns and Lehman Brothers. I don't know how it unfolds, but it's going to be ugly. And that is why we come to the last chart. The energy cliff trigger, the world will move back to a physical economy, which is all we really have been, and a transition from building wealth to protecting it. When you start to have a decline in energy production, it'll be very difficult. It'd be very difficult for people to build wealth because they're going to have to survive now. Some people can build wealth, but I want you to think about this. Think of like a family. They've got brothers and a son, and they've got 4 different homes. Everyone's got their own home. As energy production falls, it's going to be very difficult to continue paying your bills. So one of the family members is going to move in with another. That's how it's going to start. And it's just going to continue. We're going to see 2, 3 families living in one home. It's going to destroy real estate values. So right here, this is the global Main Street asset universe, 340 trillion globally of real estate, 133 trillion in bonds, securitized debt, 112 trillion in equities, total 585 trillion, doesn't even include the shadow banking system. So this is the total global identifiable physical gold and silver, about 2.6 billion in central bank and public and private gold investment in the world, and about 5.5 billion silver. That's it. You add them together, and these numbers are a little higher because the price I figured was low. It's 5.1 trillion. This is the real collateral on the right because it's based on storing energy value. Financial assets are based on leveraged energy growth in the future. That's an IOU. And unfortunately, institutions, high net worth individuals, and investors don't understand why they need to be transitioning more into protecting this wealth into gold and silver. So that's it, folks. That's it. That's what I told them. I said, it's amazing when you understand this information, how unprepared we are on many different levels. And I don't have all the answers, but I do understand these dynamics, and I try to share them the best way I can. And I think I want a lot of any comments or questions. I think what I'm going to do is reply in a video. I want to talk about them. But we had plenty of building wealth, and it was actually a lot of it's fictitious. It's fictitious wealth. Wait till you try to cash in that wealth. And so if we have any questions or comments, please leave them in the comment section, and I will reply in a video update. Thank you.